Thanks for joining us on Parliament. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Meera Dugal. Let's get you the headlines. Indian markets traded at a 3-month low with the Nifty and the Sensex losing 1% in intraday trade today. India WIX surges to a 7-month high.
The RBI's leeway for state-run oil marketing companies to borrow working capital from abroad fails to spur the rupee, which touches a new low on opening today.
Crude prices continue to hover near 4-year highs. Russian oil minister tells Bloomberg that Trump is to blame for the rising prices.
Supreme Court asked ArcelorMittal and Numetal to clear all outstanding dues before rebidding for Essar Steel.
Conversations coming up on the show today. We'll try and talk about why the latest bout of selling pressure has hit the currency and the bond markets. Essar Steel of HDFC joins us. We'll also get a view on the Supreme Court's verdict on Essar Steel with Shardul Shroff. That's coming up on the show.
First, the markets. It's weak. It's turned volatile. Not looking good. Neeraj is here with some closer look of what's going on.
Well, if it is possible, to be honest, one. And two, I mean, the other bit is now it's no longer the Nifty bank which is leading the fall. The last 2 or 3 sessions, that's been the characteristic, that while banks are down, but it's not banks which are necessarily falling. Look at the top losers on the Nifty today. Reliance is down 5.5%. That's stronger hands coming out and giving way. So Reliance is down 6%, okay, 6% now. IT, second on a trot, is reacting. So TCS, Infosys, etc., all of them second in a trot are correcting with a fair bit of volumes to themselves. So this is essentially profit booking and some of the stronger hands now getting out of the way. Eicher Motors was down, I think, 8% intraday, but that stock has come down from 30,000 to about 21,500, and this is a company that could do no wrong. Royal Enfield bikes were selling all the time.
As of 3 months ago.
Well, yeah, well, as of the month ago, to be honest, as well. So, but yeah, I think a lot of these stretch valuations are now getting beaten down, out of shape. I just want to pull up the market breadth. I frankly haven't seen it before coming into the show, but if you can pull up the advanced decline ratio, this is now changed materially. In yesterday's session, the difference was that while the large caps had fallen, the advanced decline ratio was positive in favor of the declines. This is back to losing ways. And, guys, every single day we've had a number northwards of 1,200 to 1,500 crores from the FI on the sell side. I fear, looking at the volumes today, it might not be any different in today's session as well. In the month of September, northwards of 11,000 odd crores FPI outflows in the equity markets. The first 3 days of October, northwards of 1,500 crores each, if not more. And that just speaks about the kind of selling that we're seeing in the Indian markets. Maybe not just Indian markets, but look at the volumes there, both on the cash and the FNO side. That tells you serious trading is happening. I'll be really interested in looking at the numbers that are coming in from the FIs and the DIs in the session today as well.
All right, Neeraj, not looking good for equity, certainly not looking good for currencies and bonds this morning. When you woke up, even before the markets opened, you knew it was going to be a rough day because global yields, the 10-year US yield had spiked quite rapidly. Oil prices were running high. And of course, all emerging market currencies were under pressure. And that's reflected in the Indian markets with the rupee hitting another low, 73.70 in early morning trade. And the 10-year bond yield at almost 8.20, a day ahead of policy, I might add. Let's welcome in Tushar Arora of HDFC Bank for some thoughts on what's going on. Tushar, afternoon. Thanks for joining us. Trying to separate what's happened recently and what the bigger picture is. Recently, it seems more and more like it's a global story, whether it's oil over the last few days or it's the US yields plus oil today.
I think it's hard to distinguish between various factors you mentioned, but if I borrow some dramatic dialogue from Bollywood, there are just 3 reasons: oil, oil and oil. I think oil is really spoiling the story for India, and I think whatever steps the government has taken in the form of incentivizing masala bonds or curbing imports, the non-essential imports, which we saw some moves coming in on that front, or the ECB's easing norms announced yesterday. I think all are going in vain just because oil prices are continuing to rise up, and I think above $85 a barrel, it is a serious threat to what the current account dynamics for India would look like. We started the year with current account estimate of around 2.4% of GDP. We increased it to 2.8% of GDP, and the kind of increase in oil prices we have seen in last 1 week, I think now the number could easily cross 3%. So I think $90 billion of current account deficit is something which is a risk, and I think financing that could be a big trouble.
Okay. Tushar, hi, this is Harsha. Given the context that we are in, that Ira just pointed out, on high oil prices, concerns about inflation, concerns over the currency, a Bloomberg survey believes that there could be a 25 basis point hike tomorrow. What's your sense, and what do you think are the factors that will be weighing on the mind of the MPC?
Yes, I think 25 basis point rate hike is almost factored in by the market. But to be honest, I think it's a very tough situation for the RBI, and I think they're dealing with a lot of complex issues. What the need of the hour in the bond market is very different right now than what the FX market is demanding. I think FX market is demanding, absorption of rupee liquidity, while the bond market, to contain the bond yields and to cap the interest rate, the servicing cost for the government, there's a need to pump in more rupee liquidity on the bond market side. So I think RBI is trying to balance these two, distinguishing requirements for the Indian economy, and I think they're walking a very tight rope. The second matter is whether the 25 basis point rate hike would ultimately really have a material impact on the rupee or not. I don't think so, because I think as an inflation targeting bank, they won't be able to categorize this rate hike as a tool or as a defense to really contain depreciation pressures. I think the discussion would be a lot more around inflation expectations, the kind of impact that increase in oil prices or rupee might have on inflation going ahead. The statement, if it is very hawkish, and if they change their stance from neutral to tightening, then maybe some impact can come on the rupee. But I think just a 25 basis point, it would just be a signaling mechanism. I think the rupee market or the FX market in general might not move too much. On the other hand, if there is a hold, I think the depreciation pressures could aggravate a little bit, and I think rupee could still remain under the pressure.
Tushar, two specific questions. One on the measures announced for the rupee yesterday. It was an interesting twist, we thought, on opening an oil dollar window. They've tried to now push oil companies to borrow overseas. There was a tweet from the finance ministry this morning which almost suggested like the oil companies don't really have a choice but to use this facility. Do you think it'll make some difference?
Well, I think if they are really forced onto, then I think it can make a difference. But if you just go by the costing perspective, I think the hedged cost of ECBs might not be so attractive for the Indian companies to go for that route. I think borrowing from India might be roughly at the same level or maybe at a better rate. So I think one idea is to leave the position unhedged. But I'm not really convinced whether the companies would like to go ahead with that unhedged position in an environment when rupee is just depreciating and it's hard to find the peak level at where it will stop down. So I think unhedged they might not be willing to take. Hedged, the cost might be roughly same as what you do in India. But if there is really a strong push coming in from the government that they have to go for this route, then I think it could make a little bit of a difference.
Late last week, we did see the Reserve Bank of India come and announce a few measures to mitigate the liquidity crisis or liquidity crunch that the banking system saw. Tushar, are you anticipating a little more measures on that front by the RBI tomorrow?
No, I think liquidity-wise, situation is kind of stabilizing now, and I think, to be honest, that sort of move on OMOs wasn't really anticipated. 360 billion in a month is, I think, a good enough measure. I think, and from the liquidity side, things could balance now. But I think there could be other regulatory measures which RBI might focus on tomorrow along with the rate hike. I think the key to watch out would be the language of the MPC, how they are looking at inflation risk panning out, not just in next 2 or 3 months, but over a year. What sort of correlations and regressions and the kind of impact they give in the form of that X percentage depreciation in rupee could have this much impact on headline inflation. These are the numbers which I would be looking into, and I think if the language is very hawkish and if there's a change in stance, then I think there could be some containment of rupee depreciation pressures.
All right, Tushar, we'll leave it there. Thank you so much for joining us. That's a view from the economist of HDFC Bank about what the RBI is likely to do tomorrow. Look, this is the backdrop that Monetary Policy Committee sits down for the October review meeting. Is there a case for the 6-member panel to step beyond its inflation mandate? That's what most experts in the market are believing. IRA is standing by with some of those factors or some of those complexities in the current environment that the MPC will have to consider. IRA.
All right, it's actually an exceedingly complex backdrop to the MPC, and against that backdrop, the binary decision of rate hike or no rate hike may actually seem fairly simple, but the inputs into it will be anything but. This is sort of the range of things that the MPC needs to worry about. Their core mandate, which is inflation, they balance that out with growth. Current account deficit, which is not their core mandate, but does feed into their core mandate of inflation. Rupee, which again feeds into their core mandate of inflation. Liquidity, not their core mandate, more RBI driven, and of course, the credit market environment, again, more within the realm of the MPC, the RBI rather than the MPC. So I think the way we are looking at it is that there is MPC and the MPC mandate and what they will do, and then what will complement that in terms of RBI actions. Remember, two separate entities there. Let's get into the first one, okay? Trying to, take out the signal and the noise and give you a sense of what is the first point of discussion. Obviously, the first point of discussion is the inflation dynamics. This is where we are at on inflation, 3.69, which is a touch below the 4% midpoint. But that doesn't mean that the MPC can take comfort from it, because remember, they have projected 4.8% for the end of the year as of the August policy. 2 to 6% is the acceptable band. The MPC minutes had suggested that a lot of members want to come close to that 4% midpoint. So even at 4.8%, there is some justification for policy tightening to continue. That is as of August. Now look at what has happened since August on two particular indicators, which is Rupee and oil. So if you pull up the next chart, you will see that the Rupee has weakened about 6 to 7% between the August policy and now, and oil prices have risen in double digits between August and now. So you take that first chart, remember that first chart of 4.8% end of year projection, you add some inflation upside risk both on account of Rupee and oil, and you automatically see an MPC which is completely justified in announcing at least a 25 basis point hike, perhaps with a reversal of its neutral stance. That is what the expectation is. The question then is that can they justify a 50 basis point hike? Why do we need a 50 basis point hike? That reason perhaps takes away from inflation and the core mandate of the MPC a little bit. And that brings us to the current account deficit argument. Now, the current account deficit is expected to be anywhere between 2.5 to 3% of GDP. 3% is the absolute red line. And in a year when there are capital outflows from the portfolio account, at least, it's certainly something to worry about. Now, the problem here is that the current account deficit can be analyzed in various ways. If you look at it as a gap between savings and investment, you could argue that interest rates need to be a part of the solution to that current account deficit, but that is not within the mandate of the MPC. You can then look at it from a excess demand perspective and say that perhaps demand is in excess and that's leading to this wider current account deficit. But again, that may not directly be in the realm of the MPC. But some economists, Aditya of JP Morgan was pointing out, look, if there are imbalances in the economy, they will show up in inflation as well, vis-a-vis core inflation. So the MPC would probably view even the current account deficit from the lens of inflation, but they will, of course, keep a very close eye out on it. And of course, that would, if they were to hike rates in response to inflation, it would have a positive bearing on the current account and on the rupee. The final point, of course, is the liquidity management. This is not something that the MPC will debate or discuss or do anything about, but the RBI has done a fair amount to ensure that the liquidity deficit reduces, and you would expect comforting statements and measures as required to continue coming out from the RBI. The MPC would need to build all of that in because remember, if liquidity is being added, it takes away a little bit from the inflation control measures that the MPC may announce. So, those are all the pulls and pressures that will be debated. For first time, actually, everyone wants a rate hike, at least in the markets, because they know that a no rate hike scenario will be very damaging for the currency. I think about 34 or 44 economists polled by Bloomberg said that there would be a 25 basis point hike. That seems more or less like a given. The question more is that does the neutral stance get taken away? And is there even a remote probability of a 50 basis points hike? Well, those are some of the questions ahead of policy.
Interesting, Datira. Let's move on now. Russian Energy Minister Alexander Novak blames US President Donald Trump for the spike in oil prices in a conversation with Bloomberg. He says markets are reacting to the risk of sanctions and supply constraints on Iran. According to him, $65 to $75 a barrel would be the ideal range for oil. Listen in.
The market is reacting to fundamental things, but there are various factors which outweigh fundamentals of supply and demand. I think the market is reacting more to risks and uncertainties, which are leading to price appreciation. And these risks and uncertainties are connected to sanctions and lack of visibility in relation to this topic, and of course to GDP growth rates, global GDP growth rates, which are also affected by sanctions, and there's little visibility in these spheres. And I think that there is little chance that such market sentiment would change during the next month, at least until we have some clarity at the beginning of November. Because no matter what happens to supply and demand, there will always be the risk of sanctions affecting it more. And I think that no fundamentals at this point in time can outweigh that uncertainty sanction factor.
Do you not think the market is pricing in the fact that you're at record highs, and that potentially means that your spare capacity is at record lows?
I think that we should not only be looking at Russia's spare capacity, but rather at a more complex picture. The market is looking overall at shale oil production growth rates. They're looking at Venezuela and North African production declines. And of course, they're looking at overall spare capacity, which the market currently has. And I mean, I think that only by looking at the complex picture can we understand, and that's what the market is doing.
But shouldn't global trade wars put pressure on prices, because the growth is coming from emerging markets?
Well, I mean, of course, there's a direct link between trade wars and potential GDP growth rates. We all know that trade wars mean a decline in GDP growth rates, and this especially affects most major global economies, which depend on trade for their GDP growth. So once they start imposing protectionist measures and going into trade war with each other, I mean, this inevitably slows down their demand growth, their GDP growth rates, and ultimately their demand growth. So overall, I mean, of course, this presents us with a negative long-term outlook if the situation continues.
We always talk about prices when we sit and meet, and there's always a range of 60 to 70. It's at 85, and some say it could be 100 at the new year. Are you worried that prices are too high?
Well, of course, such risks which you mentioned about the oil price, they exist, and such concerns do have some grounds to them. But once again, I would like to say that such concerns exist, and the price is somewhat highish due to a lot of uncertainty factors being embedded into the price. Current levels may be a little bit high. What we think the market would be striving to reach is a balance which would be, first of all, stable and acceptable to both producers and consumers. These levels are probably a bit lower than what we see today. If you've listened to the main panel, to the main event of today, the president has spoken about a range of $65 to $75, which seems to be an acceptable level to both producers and consumers, and at the same time ensures enough cash flow into the sector to reinvest and to allow it to sustainably develop.
The Supreme Court wants Numetal and ArcelorMittal to clear all their dues even before submitting final bids for Essar Steel. The two-judge bench hearing the case has also set a 2-week deadline for the two interested parties to repay their outstanding amounts. Payaswini Upadhyay joining us with the details. Payaswini, what came through?
It's all in all, it looks like a positive outcome for ArcelorMittal. For as background, what had happened at the NCLAT was that Numetal, who had gotten rid of the Revant Ruya shareholding, who's a connected party to the promoter, was allowed, or the second bid of Numetal was allowed, which was minus Revant Ruya, as eligible. And what the NCLAT had told ArcelorMittal is that, look, fine, you have gotten rid of your shareholding in Uttam Galwa, which was an NPA account, which made ArcelorMittal ineligible, as well as KSS Petron. So just because you have sold your shareholdings doesn't mean that your ineligibility is cured. You will have to cough up the amount that you are that is owed to you as on account of the exposure to these two companies. ArcelorMittal had obviously contested on these grounds to the Supreme Court and said that, look, Numetal was allowed to, or the second bid of Numetal was allowed as long as they got rid of Revant Ruya, but we are being asked to cough up the overdue amount, so that's not fair. And that argument seems to have been accepted by the Supreme Court. Of course, we don't have the final written order, but what the oral outcome was forthcoming in this morning from the Supreme Court was that both the bidders have been told that your second round of bids is ineligible, and to make yourself eligible, you've been given 2 weeks weeks to cough up the amount that is overdue. You convert your accounts into a standard account and then bid or submit fresh bids, and that process, the timeline set by the Supreme Court is 8 weeks. The biggest question in all of this is that what would it take to make Numetal eligible, because the amount floating for ArcelorMittal so far is 7,000 crores on account of Uttam Galva and KSS Petron, and ArcelorMittal had given an an undertaking in the Supreme Court that we're going to put this amount in the escrow, etc., etc. So they had said that we have no sort of hesitation in paying this. Shardul Shroff, who's the executive chairman at Shardul Amarchand Mangal Das, and has also been advising the Committee of Creditors of Essar Steel, now joins us on the phone line. Mr. Shroff, thank you for joining us here on Bloomberg Quint. The big question, I will come to what happens in the Essar Steel case and what we are to make of the directions of the Supreme Court. But what does this order mean for, structures that were possibly designed to have some promoter play? What does the Supreme Court, order mean for some of those structures?
I think what it means is that if you use a device for trying to be eligible and conceal your origins, that is something which the Supreme Court frowns upon or has clearly seen through. So to that extent, I think the Numetal structure has been exposed and they have been found out. So in a sense, now they are in the same situation as ArcelorMittal, and they have to pay up all their outstandings or overdues in any company that is run by the Ruyas. Okay. So if there are more than, of course, Essar Steel is the primary one, but if there are other companies also which have overdues, all those effectively have to be cleansed up, and only then they become eligible.
Okay, I'll come to that point in just a bit, Mr. Shroff, but was that the understanding or the conclusion by the Committee of Creditors as well, that even though Numetal had, had done away with Revant Ruya's shareholding, that didn't make them automatically eligible? So in that sense, is that the conclusion that the Supreme Court has also agreed with, one that was arrived at by the COC itself?
Yes, on the 8th of May, when the COC gave a post-hearing judgment or order, this was exactly the kind of conclusion that was arrived at by the COC. The COC had also said that both will be ineligible and that if they pay up their dues, they will become eligible. This was exactly the kind of order which has been passed on 8th of May by the Committee of Creditors, and the Supreme Court's order is effectively affirming what the COC had done on 8th May.
Okay. So since we don't have the benefit of the written order at this stage, could you give us a sense of what sort of discussion and arguments went on in the Supreme Court on the point that what Numetal would have to do right now to make itself eligible? And when I'm asking that question, I'm referring to the kind of amounts that we're looking at to make Numetal eligible.
See, the logic, as you have correctly explained in the opening, was that the NCLAT had directed that in case ArcelorMittal has to be eligible, despite dropping the shareholding, or rather getting rid of the shareholding in Uttam Galva and KSS Petron, if they were asked to pay 7,000, which was then stated to be the overdues in Uttam Galva and KSS Petron, then the same logic applies to Essar, to the Ruyas, because they have also to pay up. And in order to arrive at that conclusion, the Supreme Court was explained the linkages between the Ruya family, which is the promoter of Essar Steel, and Numetal Limited. And since those linkages are obviously now something which the Supreme Court has confirmed, the Ruyas also are liable to pay if they want to continue to be parties to the Essar bid. And those arrears will effectively be the same type of arrears that if there's any overdues which are there in any sort of company which is an NPA over 1 year, then they become eligible in the same logic as applicable to ArcelorMittal.
Okay, were those sort of numbers presented to the Supreme Court by the COC while the hearings were on?
No numbers were proposed in the case of Numetal, because it was an argument more in the nature of principle. But this obviously flows that whatever is outstanding in any of the RUIA companies which are non-performing assets will be the amounts overdue. This is a reading of Section 29AC, and from that reading, this becomes the principle.
So it would probably not just be Essar Steel, the amount overdue in the Essar Steel case, but several of the other group companies as well.
The companies of the Essar group which are non-performing assets for more than 1 year, all these accounts have to be rendered standard in the event that Essar wants to be in the race.
All right, Mr. Shroff, thank you for joining us with your understanding. Back to you guys. We'll, of course, know the final number if and when the COC does the math and the final order is out.
All right, Pasini, thanks for that. IDBI Bank has decided to reclassify LIC as the founder. The board meeting outcome was put out on exchanges a little while back. Vishnath has the details.
Right, Hira. So, as part of the board, IDBI Bank board's decision, they've decided to issue fresh equity to LIC. They want to ensure that 51% equity in the bank rests with LIC and that it be classified as the promoter of the bank. So, according to a top official at IDBI Bank who spoke to us on conditions of anonymity, he pointed out specifically that the next step is now to determine the price at which this transfer of shares should happen, and that will be determined within the next couple of days. Once that has been finalized, then there will be some clarity on the amount of money that LIC would have to pay so that they can control the 51% equity in the bank. Furthermore, there's regulatory approvals which are still pending. They also have to get shareholder approvals from IDBI Bank shareholders before this process goes through, and all of this process, according to this official, could take a little over a month. So that's when we're likely to see the process of IDBI Bank being completely taken over by LIC completed.
All right, Vishnu, we'll leave it there. Many thanks for joining us. Out of time on the show. Thank you so much for joining us today.